First off, we want to thank the organizers for including our paper on the program. Of course, thank you all for attending as well. So yes, my name is Sam Rosen. I'm assistant professor at Temple University. And this is joint work with my colleague Sebeom and Anthony Lee Zhang at the University of Chicago. So as I'm sure many of you are aware, there's been the recent development and massive growth in the market for so-called non-fungible tokens, or NFTs. Now, a large set of these digital assets represent claims on digital artwork or digital collectibles, some of which have sold for seemingly absurd amounts of money. So I have a few examples here, as well as their associated price tag in USD. So traditional companies have started jumping in on the NFT craze and issuing their own collections. And we want to take a step back, maybe put aside this massive growth and these really high valuations. And from our perspective, we actually think that the NFT market represents a really interesting market to study as researchers. And why is that? Well, if we look at this market, these are digital assets. They're a relatively opaque asset class where you have millions of unique assets for which there's relatively little public information, low entry costs. And when you look at these characteristics, they should remind you of other markets that we as finance researchers have studied more heavily, such as housing or venture capital, and even the market for stocks. And when we look at prior empirical research, motivated often by theoretical analysis, these studies have tended, in those markets, have tended to find that experienced or better informed agents tend to outperform. And so therefore, we expect to find a similar result for experienced investors in the NFT market, that they will outperform their inexperienced peers. So we're going to take this hypothesis to the data, and we're going to ask the question, do experienced investors, in fact, outperform in NFT markets? And if so, how much? And of course, why, or if we can understand what are the drivers of this outperformance. And by doing this, by answering these questions, we also hope to shed light on the broader NFT market in general. So what do we do in this paper? Well, the first thing we do is we build a comprehensive data set of NFT collections and their associated transactions on the Ethereum blockchain. Now here I want to highlight that actually one thing that's really special about the NFT market is this amazing data we're able to compile that includes primary market transactions, all secondary market transactions. And so this is, I think, really special relative to what we're able to determine in these other markets that I mentioned before, such as either housing or venture capital. So our headline finding is that experienced investors do in fact outperform. And specifically, we find that they outperform on the order of 32 percentage points more higher returns per trade on average. So for some context, this is a very large number. So those previous empirical studies I mentioned, they tend to find much lower rates or amounts of outperformance in those other markets. So once we establish this headline finding, we want to understand more, we want to try to decompose kind of where this outperformance is coming from. And we find that most of this outperformance, around 80% of it, can be attributed to the fact that these experienced investors tend to participate much more heavily in the primary market, in which we see that returns are on average a lot higher. We find that the rest of this outperformance we can attribute to the fact that experienced investors are better at picking collections. And this is something we can determine or at least infer from our return level analysis. Now, interestingly, we actually don't find any evidence of outperformance by experienced investors in secondary market trades. So we really find that the primary market is where they seem to have their advantage. Now, returns is not the only place that we're able to see this superior collection picking ability. In fact, we're able to validate this aspect by looking at NFT collections that were more heavily purchased by experienced investors. And here we find that at the collection level, these collections are much more likely to sell out. They sell out faster, and they experience higher post-sale price growth. once again, highlighting that experienced investors are able to essentially pick better collections to invest in. So overall, taking a step back, our evidence suggests that there are substantial inefficiencies in the NFT market. And as a related note, we also believe that if you look at this market, a new NFT investor who sees these high returns to previous investments would be at a disadvantage when entering, given the strategies we're able to determine for the experienced investors. All right, so before we get into the data analysis, I just want to be clear and make sure that we all understand just generally what an NFT is. So NFTs, they're digital assets. They're held in blockchain wallets. And by being digital assets, if one is able to, or as digital assets, owners of these NFTs are able to verify their ownership through their public wallet address. Now, of course, if you want to actually trade or send NFTs or buy NFTs, you'll need the private key for your wallet, but you're able to at least signal or verify ownership just with the public address on its own. Now, what makes NFT special relative to other crypto assets? Well, it's essentially in the name, which is that they're unique, so non-fungible, but they're also indivisible. So NFTs are traded primarily, almost entirely through online trading platforms. And so here we have a screenshot from one of the most popular online NFT trading platforms called OpenSea. And so I showed you this picture not only to give you a sense for the types of digital artwork that are associated with these NFTs, but this also gives a sense of what a potential investor would look at in terms of browsing potential NFTs to buy, looking in different collections, and perhaps making offers on an NFT of interest. So why do people buy NFTs? This is really kind of a million-dollar question here, which I often get asked a lot. So our view is essentially that NFTs are digital status goods. And one way to see this is through the following example. So Twitter recently allowed users to put NFTs as their profile pictures. And to see how this works, let's take the following example. So on the left here, we have my co-author, Anthony Lee Zhang, who's opted for the traditional profile picture of himself. And given that this is not an NFT picture, his picture or the border of it is a circle. Now compare this against this user on the right who owns a Bored Ape, which is one of the most popular and valuable collections. So he is using his NFT as his profile picture. And as a result, the border is a hexagon. So this user is able to credibly tell everyone in the world that I own this very, very valuable NFT, and it is his profile picture. So the Twitter profile picture, this is just one way to see NFTs as digital status goods, able to signal wealth by showing that you do in fact own this digital object. But there are other benefits that confer similar types, or there are other ways that NFTs confer similar types of benefits. So for example, if you own NFTs in certain collections, they give you access to online groups. There's also ways in which NFTs get you access to events in real life as well. So I'm actually going to be presenting this paper next month at a conference, an industry conference called NFT NYC. And a lot of these NFT collections are having events at this conference. And if you want to get into them, you actually have to own an NFT and you have to be able to show you own it in your digital wallet. Now, beyond just some of those events, there's also a lot of talk about NFTs being particularly useful or being parts of these online metaverse worlds that these companies are building. So this is the kind of utility argument for NFTs. But of course, it's hard to ignore the fact that we've seen such high returns in this space that no doubt some investors are going into this market speculating, hoping to earn a high return on these assets. All right, so let me tell you a little bit about our data. So we study about 700 what we call generative collections. And so we have a formal definition in the paper, but these are essentially collections of NFTs where each item is a variation on a similar theme. Other features that make a generative collection is that there's a prefixed amount of items that they plan to sell, and also that they conduct their primary market sale in such a way where an interested buyer goes to their website, clicks, I want to buy an NFT, and then actually gets a random object from the collection. And we think it's important to focus on kind of a similar types of NFT collections. So that way we're really comparing kind of similar types of assets in our analysis. Now we determined this set of about 700 by reviewing all the collections that we found on OpenSea back in the fall. And so despite the fact that there may be a smaller percentage of the number of collections, these generative collections do make up a large percentage of the volume of NFT sales, thus indicating that they're a relatively popular and common type of collection. So in total, these collections contain 2.9 million individual NFTs. We get some information about the collections from either their web pages or other online searching. And then we're going to get transaction level data from the Ethereum blockchain. So let me tell you more about the transaction level data, because this is really going to power a lot of our empirical analysis. So what we observe is, or what we've gathered is all on-chain primary and secondary market transactions from the period March 2021 to March 2022. So we've only recently updated our data set. So if you saw our paper online, there's a shorter time period, and now we have a longer period of results, and all of our tables are going to reflect that. So what do we see in this data? Well, we see the date and the time when this transaction happened, the price, associated fees, what item was actually sold, as well as the wallet addresses of both the buyer and seller. So in total, there's about 6.1 million transactions, and about half of them are what's called mints. And that's just the industry term for when an NFT is created in the primary market. The remaining trades are secondary market trading, which occur primarily through these online platforms such as OpenSea. So I want to give a tangible example just to make sure we all have an idea of what these NFT collections contain. So I'm going to use Subducts, which, to be clear, is a relatively successful NFT collection with 10,000 items. They meet all of our definition requirements, and they were launched back in July, summer of 2021. And so here we have a few examples from the collection where you can see that these are all variations on a cartoon duck. And also within these examples, we can see something we're going to show formally in a little bit, which is that these collections tend to have trade around a similar price that we can see here for these two objects, but there are rare objects or more valuable objects within the collection that tend to yield or tend to earn much higher prices when they're traded in the secondary market. So here's a scatter plot that shows what the primary market sale of a collection looks like. So this is still the Subducts example. So these gray circles are mint transactions, the primary market sale, and then the triangles are secondary market transactions. And so what we see is for this particular collection, there are actually 3 tiers of mint prices, meaning that there are 3 prices you could potentially buy in the primary market sale. And we see that almost immediately there are secondary market trades as the primary market sale continues. And what we can also tell from this picture is that it's not until the primary market sale is near completed that we actually see secondary market prices start to move upward. And this makes sense because if you're interested in buying into the collection, you'd rather buy from the pre-specified mint price than the higher price in the secondary market if it's available. All right, so for the next few slides, I want to tell you just some stylized facts about this market. And so I really just want to focus on things that are going to be helpful for understanding and hopefully appreciating our empirical analysis. But if you're interested in learning more about this market, certainly consult our paper where we have a lot more interesting descriptive figures. All right, so the first thing I want to tell you about the primary market is the fact that the outcomes in this phase are very much bimodal. So here is a histogram showing a measure of success in the primary market, which is how many items did you actually sell compared to how many items you actually wanted to sell. And we see that about half of the collections are able to sell out all of their items, or mint out as the industry term. And then we see that the kind of remaining mass tends to actually be towards more closer to zero, meaning they sold very few items and effectively failed in their primary market sale. Now, we think this is important to keep in mind, given that, as I said on the previous slide, the success in the secondary market price growth is definitely tied to the primary market success. So speaking of secondary markets, we have all of the secondary market on-chain transactions. And we run the following regression where we take the log prices that they're traded at and regress them on collection date fixed effects. And when we do this, so here's a histogram of the residuals. But before I get to that, when we run this regression, one thing that we find is that about 80% of the price variation that we observe across NFTs is absorbed by these GC date fixed effects. When we're looking at the residual from these regressions, we see, as I mentioned earlier with those subducts examples, that this distribution is skewed, or is right skewed, meaning that there are some, within a given collection, there are some items that tend to trade further away from the price, from the average price. But the bulk of items within a collection tend to trade around a similar value. And we take these two stylized facts together, and we use them as motivation for constructing GC collection level price indexes as the 25th percentile price observed on any given date. All right, so now I want to tell you about how we determine experienced investors within our data set. So there's about 540,000 unique wallets within our GC sample universe. And when we start to look in the transaction data, one thing that became apparent was just that the both primary market and secondary market activity tends to be very concentrated. And one way to see this is that about half of the mints are from wallets that minted from 6 or more collections, and about half of the trades, secondary market trades, are from those that have traded in 10 or more collections as well. So we're going to define experienced investors as wallets that are above the 50% cutoffs, both for mints and for trades. And to give you a sense for how many investors this is, if we do this for our full sample, we get about 16,000 wallets, or about 3% of the sample, that we categorize as experienced. Now, I want to be clear here that for the remainder of our empirical analysis, we're always going to be using a similar definition that I just laid out here, except it's always going to be defined on an ex-ante basis, meaning that whether or not an investor is considered experienced is based on its trading activity through the previous date. So just a few things I'd also like to highlight about experienced investors. So essentially by construction, by the way that we identify them, two things that we notice is that experienced investors tended to enter our sample earlier, and they also tend to trade more frequently. Now, other stylized facts we're able to show about experienced investors, just to give you a sense of kind of who they are and what their trading patterns look like, they tend to trade less than once per day on average while they're active in our sample. They participate relatively more in the primary market, and they tend to hold positions in their NFTs for shorter periods of time compared to the inexperienced counterparts. All right, so now our main results, our empirical results. So on this slide, I just highlight our main results all at once, and then we'll walk through them over the next few slides. So our headline finding is that experienced investors earn 33 percentage points higher returns per trade on average than inexperienced investors. And as I'll show you in the next slide, this importantly is controlling for the holding period of the trade. Now, about 80% of this outperformance we can attribute to the fact that these experienced investors simply mint more often, that this is a more common type of trade that they make. The remainder, we're going to argue, it can be attributed to minting better collections. Now, interestingly, there's no evidence of outperformance in the secondary market, so this outperformance can entirely be attributed to the primary market activity. So we define realized returns for any given trade. So let me walk through this subscripts here just to be clear about kind of how granular our data is. So the realized return to trading item, or that to investor I who trades item J from collection C, sells it on date T and purchased it on date tau, is essentially the price they get when they sell it minus fees that they have to pay to the platform, as well as potentially to the collection as royalties. And then subtract off the price they paid for it minus the gas fees, the transaction fee on the Ethereum blockchain that they paid to purchase it. And this is all divided by this initial amount, in this initial outlay. Our regression is we're going to take these realized returns at the trade level, and we're going to regress it on a dummy that says whether or not the investor was experienced. And then we're also going to have controls for the holding period, as well as collection time and collection time fixed effects, depending on the specification, and in some cases, even item level fixed effects. All right, so this is our first table where in the first column, we show our results where all we have is the dummy, and we actually don't have any of those fixed effects I just mentioned. And here we actually find that this raw average outperformance is actually negative. But remember, as I told you earlier, experienced investors tend to hold their trades for shorter periods of time. And so we can control for this either directly in terms of time trade held, or in our preferred specification, we include buy by sell date fixed effects. And we see by controlling for this, the holding period, that now the experienced investor outperformance is on average not only positive, but very positive. In fact, about 33 percentage points per trade. So now let's dig a little bit more into this outperformance. And so in this table, in these first three columns, we essentially remove our experienced seller dummy and replace it with a dummy that just says, was the previous trade on which that's being realized, was that a primary market purchase? Was that a mint? And what this very large and significantly positive dummy tells us, coefficient tells us on this dummy, is that returns to mints are substantially higher on average than secondary market sales, on the order of about 300 percentage points. So what we do in column 4 is we take our specification from the previous slide, but now instead of buy sell date fixed effects, we add in whether or not it was a mint to this combination of fixed effects. So effectively controlling for whether or not the previous trade was a mint. And when we do that, we see that this outperformance drops from 33 percentage points all the way down to 6 percentage points. So about an 80% decline in the outperformance. So let's dig now a little bit further into the remainder of this outperformance. So we show that about 80% is due to minting more often. What about the remainder? So the first thing we do is we just rerun that regression in the final column from the previous table, and we run it separately on the subset of realized returns that were previously mints versus ones that were purely secondary market transactions. And so here we see that the positive and significant outperformance is only present for our mints only regression. And in fact, when we look at within the secondary market transactions, we find no evidence of outperformance whatsoever. So now we're going to dig further into that outperformance within the set of mints. So that 9.3 percentage points that was in the middle column. So this is the first column in this table. And essentially, when we control for either collection level fixed effects or even buy by sell date by collection level fixed effects. So when we control for collection in either of these two ways, we see that this outperformance entirely disappears as well. And so we interpret this as the fact that when controlling, now that we're controlling for collection, the outperformance goes away. This means that experienced investors, this outperformance must be due to the fact that they're just picking better collections to invest in at the minting phase. So that table or the previous return results are not the only way that we're able to infer the experienced investor's ability to pick collections. We also define a variable. We also do a collection level analysis where our key variable of interest here is going to be what percentage of the investors in the primary market sale were experienced. And we find that this variable is highly predictive of whether or not collections are successful in the primary market stage. And specifically, collections with higher shares of experienced investors are more likely to mint out, and they're more likely to mint out faster. So these two panels here are bin scatter plots that show this connection pretty clearly. Now we run this in the paper, we run kind of cross-sectional regressions where we include a lot more characteristics of the collections and essentially find a very similar result. So we also looked at whether or not that same variable, share of experienced investor participation, whether or not that predicts post-minting period price appreciation. So we define a collection level price index as described earlier, and then the return in the post-minting period would be that price index divided by the weighted average mint price during the primary market period. And so this table, we show the results of this cross-sectional regression for either returns to the collection level, 1 or a week, 1 day or 7 days or 14 days, essentially up to a month after the primary market. And we see that the fraction that was minted by experienced is still highly predictive of this price appreciation, meaning that experienced investor involvement strongly predicts post-minting price index returns. So in the paper, we have many additional analysis. We look at features that predict experienced involvement. We look at the role that the price paid in the mint returns. We look at unrealized gains as a form of robustness. And we also look at some collection level pricing dynamics and how they relate to experienced investor ownership. Unfortunately, I don't have time to tell you much about this today. So instead, I'm going to, or at this point, I'm just going to conclude. And I'll reiterate that we find experienced investors systemically outperform inexperienced investors in the NFT market on the order of 33 percentage points per trade. We find that the majority of this is due to the fact that these experienced investors mint more often where returns are higher. And the remainder, we argue, is due to the fact that experienced investors are able to pick better collections. So overall, these findings suggest that there are substantial inefficiencies in the NFT market, and also suggest that a new NFT investor hoping to earn similar returns to what they've seen in the market so far are going to be at a disadvantage. All right, thank you very much for your time, and I look forward to the discussant's comments.
Sorry, I was still muted. Thank you so much, Sam, for your presentation. That was really great. Well, I'm not only your host right now, I'm also your discussant. So please give me a second to share my slides. Maybe you can, yeah, perfect. And slides. Should see the slides right now. It's not full screen, but okay, should work, right? Let's see if this works. That works.
Yeah, I can see it. Looks good to me.
Control L, right? You should still see the slides, do you?
Yep, I see them full screen.
Wonderful. Thank you for confirming. All right, since I'm now taking over the role of discussant, probably in case I jump over the time, Zhang or Gavin, you will just interrupt me, yeah? So that I stay to my 10 minutes, which are allotted. So
I mean, I'll try to. I'll say
I
something.
want to discuss Sam's, Sebeom's, and Anthony's paper on investor experience matters, evidence from generative art collections on the blockchain. So what do these guys do? First of all, this is also the reason why I really wanted to discuss this paper, is because they provide a very detailed introduction to NFT market. And I wanted to simply know a bit more. What is this all about? What can you do with this market besides what I saw in the media or like by clicking through websites? They also explain very well how you can invest in this market, how it works, and how experienced investors do have an advantage here. And they also investigate then simply if they outperform experienced newer investors. So their findings. So here I will first define in my own words how I understood the term experienced investors. So these are simply guys who are in the market for longer and have transacted various times. And these guys gain then, as by the evidence, about a 33% higher return on trades with similar holding period. However, 27% of this is because they participated in the mint already, and another 6 because they picked simply the more valuable collections. And we have no outperformance in the secondary market. So from this, the authors then conclude that we indeed deal with experienced investors do better. But I ask myself, but if they don't outperform in the secondary market, how do we have them actually experience really shown here? And when I thought about what a mint actually is, something else came simply to my mind, that we're dealing here with something like an IPO, right? Because these mints have these whitelists, which gives certain investors, actually the author explained very well in the paper what a whitelist is. They simply give you better access to the minting period. You have simply preferential access, and you can, during the minting period, execute your right to buy at any given time. This is good because you're not subject to the potentially high gas fee on the blockchain. So you can really pick your time when you want to buy and save potentially some money on that. And 27% of this outperformance is simply due to that. Another 6% is because they can also pick better collections. But they also have access to these different kind of collections. So, and they have not the obligation to buy, they have the right to buy. So they can choose if they want to go into a certain project or not, at their own discretion. And this all of this simply reminded me a lot on the kind of option of the underwriting banks during an IPO to get in. So I wanted to know what are actually the numbers there. Do you actually can compare this? And I found this this graph online, which shows us the average first day IPO gains in the US market over the last 12 years, 14 years, sorry. And it's not the same as 33%, but it still is pretty much potential. It's just like the first day gains. So we're seeing here indeed a kind of similar structure I kind of got from that. And then I wanted to know simply, okay, now I know what these, that the whitelists are really the thing here, which help me make money in this market. How do I get on one? First thing I did is just Google, how do I get on a whitelist? And the first Google hit gave me this article from Fortune. The takeaway from the article is basically look early on for projects where you think they have potential. Then engage with the team, promote the project, show them that you're interested in it, show them that you work for the project. If they give you requirements for being whitelisted, then just do whatever they want until you're valuable enough for the project so that you get whitelisted. And then potentially, that's what the article says, you have the option for huge return. And they picked out this particular example, this NFT called Prime Ape Planet NFT, which minted at 0.25 ETH, and then within 48 hours jumped to 2.3. So you could basically make almost 1000% of gain just by being engaged early with the entire project. So really, the essence here are indeed the whitelist. So I was asking myself then, since we also don't see outperformance of these experienced investors in the secondary market, maybe it's less about experience, more about being part of that system and to be on this whitelist, which explains this outperformance. So these results rather show that preferential, or here I put it in brackets, early access payout instead of being experienced. So I would just, my suggestion for this would simply be to amend the direction of the paper a little bit and just say, instead of experienced investors, this is a quantification of early access rights in the NFT market. How valuable is it actually to be on these lists? Another thing which struck me is then on the analysis. So when I was reading through the paper, I think I got the impression, I hope I'm not wrong with this, Sam, interrupt me if that's the case. I think the authors actually measure the price in ETH. So one ETH is always one ETH, right? but not in US dollar.
That's right.
But what they also view that this kind of entire investment thing as a kind of that it's more about investment, not about like owning an NFT. People want to simply make money. But from purely profit maximizing viewpoint, maybe measurement in US dollar is more appropriate here, because the results could change a lot if we just look here at the exchange rate of US dollar to Ethereum. I took you the exact date, the exact time period, which is covered in the paper I had. I think the results are outdated. So this is like 1st of April to 20th of September last year. And well, if I would have bought an NFT here at 2,000 US dollars per ETH, and then someone gives me a little bit less, but we're here, I would have still sold. I would have still doubled my investment just because the price of ETH went up. So I would just suggest to probably rerun the analysis and check if the results still hold if you quantified in US dollars. Yeah, also it struck me that the authors do control simply for the holding period when it comes to the measurement of return. Yeah, which to me was a bit new. I have not seen before that this is done. So and the results then simply show that these experienced investors hold onto their investment for a shorter time. But without control, they actually underperform. At least this is how I understood the first regression. If I misunderstand it, Sam, please correct me. Overall, they do not outperform, only when we take into account that they sell very quickly after the minting. However, this gives them a different opportunity. They simply free up capital. So I wanted to just suggest that you could also include like the potential for alternative investments during this period, for which to control for that. Otherwise, simply another investor holds, let's say, for 10 days, doubles the investment, and someone else for 2 days only makes, I don't know, 50%. But in these 8 days, you can invest somewhere else. Just a suggestion, maybe it helps. One more thing, when I looked through the paper, I came across table 8, and there is, probably you updated it already. I compared the R squares, which was a bit difficult because the number of observations differed, but something struck me that the R squared shrank when we had more parameters in the model, and even one more significant than before. So I was not really sure what to make out of this. And if we look at the regression next to it, even more parameters, even more significant, and even lower R squared. Again, a diverging number of observations. So probably you wanna have a look, or probably just compare with the same number of observations, what happens there. And the last thing which came to my mind is, and then I read through that you guys simply only take these collections where you have at least 5 trades on any given day. And this is fulfilled by about like 50% of these generative collections, if I'm not mistaken. But 5 trades a day is also not that much, right? So it's still high illiquidity, really illiquidity. And in this crypto market, we do have the problem that prices get pushed up. So with such illiquidity, it would be really possible to simply sell to yourself, because nobody knows who are actually behind these wallets. So you could actually generate a higher price just to finally find someone who thinks, oh, the price goes up, and then actually buys from you. So I just want to suggest maybe a robustness check by taking a subsample of these GCs with even higher liquidity. All right, that's all from my side. Feel free to directly say something to the suggestions.
Sure. Yeah. Let me just, I guess, quickly respond. And I see that there's, I think, some questions in the chat too. So I'll get to those in a minute. But yeah, thank you very much for this discussion and for these. I'm glad you liked the paper and learned something from it. That's always great to hear. And also that I think a lot of these suggestions are great. So just a few comments. As far as the access side of things, we agree that access is at least part of the story of their primary market outperformance. And I like your comparison actually to the stock market and IPO underpricing. And in this sense, I think we're actually kind of consistent with other studies. So ones that have shown that access it also helps drive results in the venture capital and private equity space. But one thing I'll say is that one piece of evidence that not all of our results come just from whitelist access and this is something I didn't highlight in the presentation, but we actually find that experienced investors don't pay lower mint prices to get into these collections. In fact, they pay higher prices to get in once we account for the gas fees that they pay. And so the fact that they're kind of more keen to get into certain collections suggests that there is an information story where these investors who can choose among lots of whitelists to participate in seem to be able to identify better which ones are actually going to perform after the mint sale. Otherwise, I think fair point that we should definitely rerun our analysis in USD as well. And then with the price index selection, the subsample approach, I think is a smart one. And we're actually also working on getting some what's called floor price data, which would be a direct measure, not so much of that requires liquidity, but says, at any given point, how much could someone feasibly go out and just buy an item in a collection? Just essentially, it's an available for sale price. And we think that would help also address this illiquidity concern.
Thank you so much, Sam. Then I think we should go to the Q&A. We got roughly 5 minutes left. I think since there already a question in chat, we will go there first. The first one is is it possible that an inexperienced investor become more experienced through learning and trading? So some of the investors are inexperienced at the beginning, but become experienced once eventually. What do you think?
So the answer to that is definitely yes. So, as I mentioned, we use this ex ante definition of experienced. And so accordingly, all of the experienced investors in our data set were at one point inexperienced investors. So it's only once we observe that they've participated in a sufficient amount of transactions and in various collections do we kind of reclassify them. So I think that's definitely what's going on in the data and something that we also account for. Okay, so this next question, I guess, should I just read it? And
sure, just go ahead.
Yeah, so it's so is the outperformance, can it be attributed to experience or fundamental differences between informed versus noisy investors? So informed investors can hold for a shorter period of time and trade frequently because of the feedback effect. So I think here maybe kind of related to the point about kind of either access or information or skill, kind of where exactly their performance is coming from. I think your story makes sense that if these are informed investors compared to noisy, that they're able to generate returns from that perspective. And something we are working on is trying to maybe be a little bit more precise or have some more evidence to help understand kind of exactly which channel is even driving this ability to invest in pick collections at the minting stage.
All right, thanks,
All right.
Sam. I think we have some questions from the audience as well. Let me hand the micro.
So I have a question on an alternative story about kind of more market manipulation, right? So I know there's a paper on IPOs and fraud, and if you think about experienced investors here, I mean, if I sell my first piece of art in Sotheby's and I have 6 friends in the audience, right, and they're all bidding, that will generate a lot of hype for me. And there's a lot of incentives here, right? So we would want to know, are these experienced investors, are they my friends? Are they connected, or are they truly, other parties? So is this something you've thought about?
Yeah, it's a fair question, and it's definitely something we've thought about. Where I'll say that I think this is actually kind of in some form or another, I think a question we definitely get often, where there's definitely perception out there that there's a lot of wash trading or this kind of price manipulation going on. And it's something we actually are actively kind of working on ways to study and try to quantify a little more carefully. One thing I will kind of point out, though, is that I guess let's say wash trading or this type of manipulation in this market is not necessarily an easy or let's say a costless strategy. So you have to pay gas fees, and there's also the fact that if you were detected doing this type of activity, could really hurt the collection's chances in a longer term sense. So I think whether or not such a strategy is really profitable, I think is also something that's not even clear at this point, but it is something that we certainly plan to try to investigate more carefully.